If you run a rental portfolio, then the variables have just shifted. The November 2025 budget is out and the government has effectively squeezed the efficiency of the entire private rental sector. This isn't about politics, this is about your P&L. These are new hard costs that directly affect your yield, your cash flow and your long-term forecasting. I'm going to run you through the 5 actual changes you need to plug into your spreadsheet today and the rumours that turned out to be false. So first up, and the most significant for personal owners, income tax changes. From April 2027, the tax bands on rental profit are moving up. We're looking at 22% basic, 42% higher and 47% additional. To be clear, that flat 2% hike is across the board, up from the old 20, 40 and 45. In fact, as we go through this list, you'll spot the theme emerging. The Chancellor seems to have found the 2 button on the calculator and just kept hitting it. But let's look at the impact of that. If you have £10,000 of rental profit in the higher rate band right now, your liability will jump by £200 a year. Doesn't sound like much in isolation, but it's a direct increase in overheads. And crucially, for those with mortgages, the tax credit relief is now calculated at the new basic rate of 22%, which is a good thing. So if you're highly leveraged, meaning you have a high loan to value across the portfolio, that slight increase in the credit softens the blow mathematically, but it doesn't fully offset the higher tax on the profit. But the takeaway for this first one is that now holding assets in your own name just became slightly less efficient. The next big change is dividends. And you guessed it, 2% change. This impacts those of us who are using limited companies like myself. Many investors have moved to SPVs over the years to mitigate Section 24. And the Treasury, predictably, has spotted that trend. So from April 2026, the cost of extracting profit from your company increases by 2%. Your rates will be moving to 10.75% at the basic rate and 35.75% at the higher rate. So if you declare, say, £20,000 of dividends in the basic band, your personal tax bill will jump by roughly £400. But you just need to think of this change as friction cost. It's capital that isn't compounding in your accounts or being reinvested. It's a net reduction in your return on equity. Now the third big change is savings tax, and it's affecting both the general public and landlords. Yet again, 2%. From April 2027, tax on interest outside of ISAs aligns with those new income bands. As investors, we tend to deal in liquidity, so you likely have a void fund or a boiler explosion fund sitting in a high interest account. If that cash is currently in your own name and earning over your allowance, the government is going to take a bigger slice of it now. It's not going to bankrupt the business, but when you're modeling your cash flow, you now need to account for a slightly lower net return on the money that you're saving for a rainy day. Now, change number 4 is one they've been talking about for years, and it's the mansion tax. From April 2028, residential homes in England valued at over £2 million will get hit with a surcharge, and it's tiered. So £2,500 a year at the low end, up to £7,500 a year for properties over £5 million. And that's on top of the normal council tax. Now, frankly, most of us in the buy-to-let space aren't buying single units at this price point. The yield rarely stacks up. And to be honest, if you do own a £5 million home, you can probably afford a better accountant than a guy filming in his shed. But if you're operating in prime London, this is a fixed cost that you cannot pass on to the tenant. It's got to be paid by the owner. So that's quite an interesting point. And my 5th and final change that I wanted to mention that will affect landlords is the visitor levy. Local mayors are gaining the power to charge a levy on overnight stays now. This targets hotels, but the wording suggests it will include holiday lets and serviced accommodation. So if you run a serviced accommodation strategy, you'll have a new variable to account for, and it's effectively a per night tax. You'll have to either absorb it, hurting your margin, or you increase the nightly rate, which could impact your occupancy. This is currently out for consultation, which usually means they've decided to do it, but just want to send some emails first. Right, so it's also briefly worth noting what didn't happen. The rumour mill was working overtime on this one over the past few months, but there is no national insurance on rent, and there is no massive overhaul of stamp duty, and local housing allowance stays frozen. The fundamentals of the market remain, but the cost of doing business has ticked up. So what do you do about this change? Well, you need to rerun the numbers. You need to stress test your current portfolio and any new deals against these new tax rates to see if they still make sense. So to help with that, I've updated my property investment spreadsheet to reflect these changes. It's a free resource and I've linked it in the description below, and it's via my website. And if you're looking to get into property, or you already have a portfolio and you're not sure how to navigate the next year or two, I do have a few open slots for one-to-one strategy sessions where we can go through your specific situation in detail. The link is down there as well. But overall, don't panic, just look at the data. Thank you for watching, and I'll catch you in the next one.